Hi everyone, this is Arjun here from Quantinsty. A very good morning, good evening and good afternoon to all of the attendees for the webinar today. Our webinar for today is going to be all about classification of quantitative trading strategies, which is going to be taken by Radovan Wojtko, who is the CEO of Quantpedia, which is a website that's an encyclopedia of quant trading strategies. Quantinsty is a pioneer algo trading institute. A little bit about our speaker today. His name is Radovan Wojtko, and he's been the CEO of Quantpedia.com since 2015. He has his master's in telecommunication from Slovak University of Technology. He's a former portfolio manager at Tatra Asset Management. That's the biggest asset management company in Slovak Republic. Managed over 300 plus million euros in several quantitative funds, focusing on multi-asset CTA, trend following strategies, market timing, and volatility trading. Radovan has already joined us for the webinar. Radovan, could you confirm that you can hear me, and if you could check whether we can hear you as well?
Yes, I can hear you. And do you hear me, guys?
Great. Yes, we can hear you, Radovan. So I'm going to hand over the presenter rights for the webinar to you so that you can share your screen. And the stage, Radovan, is completely yours.
At the beginning, I would really like to say thank you to you guys from Quant Institute, from Quantinsty, for this opportunity to speak to all of you. I would really like to show you a nice presentation. I'm not a native speaker, so please have a patience with me. And in case you do not understand something, you can ask questions, and we will get back to that later. Or if you have any other question to my presentation or to our company, to anything, you can also ask the question, and at the end there will be opportunity to answer these questions. In my presentation, I will try to show you that it makes sense to pay attention to financial academic research. There are a lot of interesting trading strategies, trading ideas which are already published in academic research and which we can use for trading, or we can tweak them or use idea from them for our own trading systems. And there is also a big uncovered space of opportunities. Some trading styles are less covered by research and therefore probably offer higher alpha. And I will show you some common issues related to implementation of strategies which are out of academic research. But at the beginning, I would like to tell you something about our company, so about Quantpedia, the Encyclopedia of Quantitative Trading Strategies. Who we are? We are a small company based in Slovak Republic, which is in the European Union, and we are engaged in the field of quant trading research. So what we are doing? We are building a database of quant trading strategies which are based on academic research. Our goal is to offer institutional clients opportunity to find new trading ideas, and currently our database contains more than 350 strategies. And what is the strategy? If I'm talking about the strategy from our database, so we read a lot of research paper. So we do reviews, and we do a summarization of main points. We extract the strategy characteristics, trading rules, etc., performance, risk characteristics, and we put all of this data into short articles, and these articles are in our database, and they can be easily screened, look up, with the links to source papers, and so on. Okay, so let me move to another slide. How we do it? So how we do it in our Quantpedia, and why I'm here while I'm talking about quantitative trading research. So academics are very smart and curious people. They do a lot of research. They try to explain how different aspects of financial system is working. and trading or trading strategies are only a smart part of it. So, but it's a part of this academic research. So they also trying to find something new in something which is interesting for us for in the trading strategies. So we read a lot of papers, thousands of financial papers which are published from universities, which are presented on conferences, sent into financial journals. Then we basically the strategy which is interesting for us, our academic paper which is interesting for us, it must pass several selection rules which are very strong. So it must be implementable. It must have some minimum backtest length. It must be well explained in the academic paper. So we do not write about black boxes. We need to see the strategy or stated performance and risk characteristics in this strategy. And once we found something like this, we create a new entry. We put that strategy into Quantpedia, and it's there in our database. A lot of the papers which are written are derivatives. So I will give one example. Jagadesh and Titman, which are two famous academics, in 1993, they wrote a paper about momentum strategy in equities in the US. So this is the first paper about momentum strategy, and there after that a lot of the papers were written about strategy in different countries, different formation periods, different variation of the strategy, and we consider this as a related papers. We link to these related papers, but we are interested in a unique strategy in the first paper, first idea of the strategy. So this is something which is interesting for us. This is our strategies, but we link also for to other papers which are related. So we have the database is bigger than only these 350 strategies. We have more than 1,000 papers linked from this strategy. Okay, so how we do it? I will mention two more things. So people often ask us if we do the backtest of a research paper or if we publish trading code. No, we do not do that. We do not do that. There are two reasons. The first reason is lack of capacity. We cover broad spectrum. So from intraday, daily, quarterly strategies, fundamental data, price data, stocks, futures, options, bonds, different asset classes, commodities, FX, equities, and so on. So we do some backtest for our own trading because I trade my own money, but we do not use this data in our database. So all of the data are from research papers only. And the second reason why we do not do the backtest is a lot of the institutional customers, they prefer to test strategies on their own data. So they have own database. Everyone uses different backtesting tools, different languages, and so on, different languages, and so on. Therefore, we only provide ideas. So we found some interesting strategy in a research paper, and we provide idea. Okay, what is the current status of research in the field of quantitative trading? So basically, there are three big groups which write quantitative research, which can be interesting for us. The first group is academics. So thousands of financial papers published every year. Basically, it's a work, it's a job. It's a job for academics. They have in their work to find something interesting, and they are trying to find something interesting. So some, as I have mentioned before, part of the research is about trading, which is interesting for us. The second group is sell-side research. So part of their research is not publicly available. What is the sell-side research? Is a research which is sent by brokers, by banks to their clients. So it is not publicly available, but big part of that became freely available, and I would say the milestone is year 2008. Because in 2008 we had the crisis, and a lot of the hedge funds had a really big problems, and a lot of the banks had a real problem, and some of the asset management companies realized that if they will be more open and if they show what they're doing, the clients will trust them more. So they started to publish. So it was also before 2008, but after 2008, a lot of the companies started to publish a lot of the interesting research. The notable examples are Acquia, Robeco, Cambria, and so on, so on. So a lot of the research, which was sell-side research for the clients, is right now publicly accessible. And also there is a buy side. So if you are working in a bigger asset management company, big asset management companies have their own research departments and they do a lot of internal research, but we do not have access to that. So this it's a short view of what is the current field. And right now we will take a look, and I will take a look of on the classification and what is the overview of quantitative trading research. So all of the data in next several slides will be from Quantpedia. We do not, our database do not contains all of the research papers ever written, but we believe we have big enough sample size to be relevant, and that it's a good representation of overall quant research base based on the data we have and based on the time we are on the market since 2011. So let's take a look on asset class focus. What we see is that research on equities is totally dominant. The reason for that is simple: cheap, free data on equities, and it's a very popular asset class among public. So historically, the equities are very well covered by quant researchers. There are a lot of published strategies on equities in academic research, and you can find a lot of ideas there. Commodities, currencies, and bonds and real estate are less explored, and so you do not find a lot of strategies published. If there is something interesting, it's very interesting because it's on different asset class, and there is a lot of space to find explore by yourself and find something which is not published at all. So there is space like that, and we will get to that later. Let's take a look on time frame focus. So quant trading strategy is a very vague term in my point of view, because historically it labeled everything from strategies from intraday high frequency trading to some long-term strategies like value, systematic value in equities, and strategies based on fundamental data with yearly rebalancing and stuff like that. So everything is right now put into the one bucket, which is called quant trading or quant investment. But in reality, there are a lot of other or different strategies. But strategies with the monthly rebalancing are the most popular, and it basically shows the popularity of equity strategies. And intraday or high-frequency trading is underrepresented, so there is a clearly space to find something interesting in this space, because the academics basically it's a very popular subject in public press. So high-frequency trading is a very popular subject, but you need to have more expensive data. It's harder from programming point of view, and therefore it's less popular among academics, and there is clearly a space to find something which is not very well known. And I will move also to topic focus or quant researchers or quant trading research. Again, topics or keywords reflects the popularity of equity strategies. So stock picking, equity long short, momentum, a lot of papers about market timing, about the value, about fundamental earnings effects and stuff like that. And if I'm counting not strategies from non-equity space, the trend following FX strategies and arbitrage and relative value trading strategies are also popular among researchers, so there are a lot of papers written about this subject. So okay, let's move on. Okay, now how to classify quant strategies, or how to classify the space of quantitative trading. There are a lot of various classifications, because the quant trading is very dynamically evolving, and the whole quant space in constant motion. I will present, or we will present, our point of view, how we do the classification, how we are trying to find something interesting in a database. And every researcher or every database has a different classification. Every researcher who is doing the meta research has its own classification. And what is the meta research? So meta research is what I'm currently showing you and what I will show you. It's when you are doing research or when you examine something based on a number of research papers and not looking directly on the data points, on financial data points, on prices from one paper. So this is what we are doing in this presentation at this moment right now. And I will also define another word, and we call it the blind spot. So what is the blind spot? We call a blind spot an area in a research which is not well covered. So we feel that there is an opportunity to find something interesting, some new alpha unique strategy in this blind spot, because it's not well covered in the quantitative research. Therefore, not well known also among other people, among public. We will start with the classification, or we will start with the multi-asset classification. So I'm showing you a picture that looks on a distribution of strategies among main asset classes and main strategy types. So we have 5 main asset classes: equities, commodities, bonds, currencies, rates. And what is the number of strategies from a momentum style, or momentum style, arbitrage, timing, reversal, and volatility timing, or volatility trading. What is the timing? This can be a word which you do not understand what I mean. The timing style is when you are trying to time the whole asset class instead of picking just the subset or the best performance from asset class. When you try to time S&P 500, this is the market timing strategy. So and the lowest axis shows the names for the best known subtypes, substyles. What the picture shows us. So the picture shows what we have mentioned, that research in equities is dominant. Commodities and currencies are less well researched, and the bonds and rates are really not very well covered. Why we have rates or real estate trust as a distinct asset class? We know that rates are subclass of equities, but real estate or rates are one of the real estate trusts is one of the few possibilities how to access a distinct asset class of real estate, and therefore we are interested to see them as an independent asset class in database to see how much research exists on them. So this is the reason how we have them as a distinct asset class. But we know that rates are basically the part of equities, and they are correlated very strongly with the equities. And now let's move on and show something more interesting. So where are the blind spots? Momentum is very well covered, very popular keyword, very popular trading style, well covered on all asset classes, so a lot of research papers. Arbitrage and relative value, so like pairs trading and strategies like that, they are well covered in equities and commodities, but there are nice opportunities in bonds and FX. And we feel we are still waiting for somebody to write interesting strategy or interesting academic paper about pairs trading in currencies. So when you try to trade euro-dollar pair against Australian dollar and Japanese yen, so like this cross-currency spreads, cross-currency currencies, we have not found any interesting paper about this in FX. So there is a really nice opportunity to find something interesting, and it's not well covered and well known. The small number of research papers is on rates, most of them about momentum, so there is opportunity in whole asset class, as I have mentioned. Market timing style, when you time the whole market, try to be in and out of the market at the right time. It's a very popular type of strategies, but we feel there are some opportunities in other asset classes than equities, because most of the researchers are trying to time equities, trying to find when they should buy S&P 500 or any other equity index and when they should sell it. So that's basically a lot of the research about equities. Much less in other asset classes. Reversal and value strategies, it's interesting space. There is some interesting space in bonds and commodities, and volatility trading is underexplored in FX, commodities, bonds. It's very popular in equities, but not in other asset classes. So these are the blind spots and the popularity of styles and how many strategies we have about different asset classes and with the different styles. And I will show you another two slides about equity classification, or about equities and about equity classification, because the equity, there are so many equity trading styles and equity strategies that we believe they need to have two more slides in our presentation. So number of strategies is higher than all other asset classes combined. And this picture shows main styles of equity trading and compared to rebalancing period. So from the left, there is an overall picture of stock picking strategies. So how many stock picking, long only stock picking strategies are there, equity long short and short selling. And then 6 main types of equity strategies. So trading or strategies based on accounting variables, reversal type of strategies, momentum strategies, timing, so again trying to time equities, arbitrage or relative value trading, and volatility trading in equities. And let's move to blind spots. As we have mentioned, lowest number of strategies is on intraday time frame. It's hard to build, hard to test properly. Therefore, there is a high opportunity to find something unique and interesting. Not a lot of research papers covers intraday trading. A low number of short-only strategies. So they are hard to build, especially daily, weekly, monthly time frame. There are some strategies on the longer time frames like quarterly, but there is opportunity to find something on a short only basis, and you will find something which is not very well known. Under reversal, it's I would say accounting and the reversal. There are some strategies which are underdeveloped in intraday time frame, and the same for a reversal. Momentum works very well on intermediary term, so it means monthly, quarterly, rebalancing, or holding period. There are a lot of papers which are dealing with the momentum trading on equities. There is opportunity to find something on a shorter time frame, but there is one question mark, because it can be just a fluke. It may be empty space because momentum doesn't work on this time frame, and we simply do not have a lot of papers on daily, intraday time frame about momentum strategies. And there is also big space. So there are some papers about arbitrage on equities, and there is a space. We believe there is a space in volatility trading on intraday time frame. Is also underdeveloped. So this was how whole space of quant research looks based on the data from our database. In the next section, I will try to show you 2 examples of some, I would say they are not the unique but interesting strategies which are less known for some reason. And we have 2 of them for you. First one is pairs trading with the commodities, and the second one is pre-earnings announcement drift. So I will give you a link to academic paper. I will explain why we think it's interesting strategy and why is that paper interesting, and how that strategy works. So I will start with the first one, the pairs trading with the commodities. What is a pairs trading? I think most of you already know, but it's a well-known strategy on equities, built as a market neutral. So you as a trader, you monitor two correlated securities historically, like Coca-Cola and Pepsi-Cola stocks. And when the correlation weakens, so one stock goes up, another stock goes down, you enter the trade. So pairs trade, short the stronger one and buys the weaker. Basically, the trader bets that the spread between stocks will converge back in the future, and you will gain the difference. The same kind of the strategy can be applied to commodity futures. So we have a lot of commodity futures, and three academics tried to develop a pairs trading strategy. They divided commodity futures into 5 groups with similar characteristics: energy markets, softs, precious metals, base metals, and agriculture. So five different groups. And they calculated cumulative total return index for each commodity in each group, and built pairs inside each commodity group. So each commodity with each commodity inside the group over a 12-month period. It's a formation period. And then you pick the top 5 closest pairs which are found, and you are looking for a way how to so you calculate the squared deviations between the two normalized price series, and you are looking for 5 pairs with a minimized sum of the squared deviations. So these top 5 pairs with the smallest historical distance are then traded in the trading period, for example, next 2 months. And then you will do the same calculation and find again the additional 5 pairs, and so on in the future. The long-short position is opened when a pair of prices has a diversion of more than 2 standard deviation, and the position is closed when the price is reverted. So basically, very similar setting to equity, to pairs trading in equities. And let's take a look on the numbers from a research paper. So basically, we are checking our trading daily, because we are checking positions daily. We trade 10 instruments, 5 long, 5 short, and backtest period is 18 years, and the performance is 1.4% monthly, is like 90% yearly, with around 12% volatility. So based on data from a research paper, it gives you a Sharpe ratio around 1.5, which is interesting for such a strategy. I would mention just one thing. This is the strategy from a research paper. So it's like idea. You can use that strategy, you can take it, you can backtest it on your own data, play with it, try different variations and stuff like this. So what we are providing in Quantpedia, we are looking for research paper like this with a nice strategy with good characteristics, and we are putting it into database to give ideas for anybody who can find who would like to see some ideas for its own trading and to try its own variation. And I will continue with the second one. The second one is pre-earnings announcement drift. And what does it mean? There is a well-known effect which is called post-earnings announcement drift. What does it mean? The stock is a claim of owner on a company earnings. So when you own a stock, you have a claim on future earnings of a company. And therefore, each investor very carefully watches how his company in his portfolio performing. And in US, earnings are reported 4 times a year, and the stocks have a slight tendency to drift for several months after earnings are announced. So the stocks with a good announcement, with the good earnings announcement, with the surprise, they drift upward. And stocks with a bad announcement or a bad surprise, they drift downward. It is possible to create a long-short portfolio, try to profit from this tendency. It's a very well-known effect. A lot of papers are written about post-earnings announcement drift, and a lot of papers have been written about it. What is a little less known is that stocks tend to drift also before earnings announcement. So because traders are people and they try to anticipate which stocks will have good and bad announcement, and they try to buy, sell these stocks before actual announcement. And this creates a drift in pre-announcement period. So therefore, again, for academics, you see a link for the academic paper. They check the trading rules on Investment Universe, which consist of US stocks, divided stocks into 10 deciles based on past earnings announcement performance during the past 8 quarters. And they basically checked every day if the stock is in a pre-announcement period, which is 5 days before earnings announcement. And investor or trader can then go long firms from the top decile, so stocks which are very strong announcers from the past, and short the firms from the bottom decile, so stocks which are really bad in the announcement from the history. And you can hold these stocks for 5 days and sell before the announcement, before the real earnings announcement. And again, let's take a look on what is the performance from academic paper. So you will rebalance daily. You have a higher number of traded instruments based on estimated sample size, but it's based on data from academic research, so you do not need to trade so many stocks. But they tested it on so many stocks. Backtest period is from 1991 to 2014, 23 years, and indicative performance is around 1% for, about 0.8% for a 5-day period, or 0.16 for a daily period. It's like 40% yearly round, and estimated volatility also around 40% yearly, so it's more volatile strategy, but a lot of the volatility is on upside, so it's not so bad from the risk point of view. So this is the second strategy. So there are a lot of papers like that which are published, and we are trying to find them, but not everything is so rosy. So let's make a clear picture. There are a lot of issues in quant research, and we need to know how to work with that issues and how to solve that issues. The first issue is logical. It's alpha decay. What is alpha decay? Basically, it's difference between in-sample and out-of-sample performance. So academics test some strategy until 2012, and the performance is something, but the performance is usually lower out of sample. There are a lot of reasons for that, and there is also performance is also lower after the publication, because once the people start to know about the strategy, once the paper is published in some journal or is presented on some conference, so there is a post-publication decay. The reason is because more money will start to trade that strategy. But it doesn't mean that the strategy will stop working at all. It doesn't mean that. It only means that we can expect less on lower performance. There is also the problem with the p-hacking and the replication problems. I will get into that later. So what does p-hacking mean? But basically, just to give you an overview, p-hacking means that researchers are testing so many different variations of strategy until they found something which is interesting, so they can publish it. But it's just a statistical fluke from, or it's just a data mining, and we can have a problem to find if the strategy is not data mined in a research. I will also talk shortly about the possible solutions and one nice idea, which is momentum in anomalies, and I will get into that later. So let's start with alpha decay. One common critique of financial academic research is that the factors or strategies or systems which are found and published, they will no longer work. So this is very common. As other players learn about them, they arbitrage all the alpha that was available before the strategy was published and so on. But this is not entirely true. I will point you to research by McLean and Pontiff. So does academic research talk really work? They show out of sample and post-publication return predictability of 97 variables on or factors in equities on a 5-year horizon. So we have some data, and we can take a look on some statistic. So it's a really nice sample, 97 factors, and we can take a look on the statistic. And we can take a look from positive side or from negative side of view. So let's start with the negative. Glass is half empty. Return is 26% lower out of sample and 60% lower, nearly 60% lower post-publication. So once the paper is published, you can expect 60% lower performance compared to the original performance from academic paper. So, but let's take a look from positive side of view. So glass is half full. So you do not have zero remaining return after the publication. You still have more than 40% after 5 years after publication, or 70% of alpha remains out of sample. So there is still some interesting performance post-publication. We just need to know how to work with that lower performance. So we can still tweak the strategy. We can still use the strategy as it was written or found in the research. We can still use just some ideas in our own strategy. So when the strategy is published, it doesn't mean that it will stop working. It doesn't mean at all. It just means that the performance probably will be lower. Let's move to the next problem in quantitative. So what is the persistence of the anomaly? So people usually think that it's easy to trade and arbitrage away some anomaly or factor. Again, it's not so true, again, because behind every trading capital, there are people, and the people are making decisions when to trade some strategy and with how much money. So a lot of the money are invested in the wrong time when the spreads offered by some strategy are the smallest one. So we have a lot of arbitrage funds trying to employ pairs trading strategies in current years when the volatility is extremely in co-integrated or correlated stocks are very low and so on. Is a bad time. Is a bad timing for this kind of the strategy. And basically, there is not. I will point you to one paper which is related to value investing. It's written by Husu, Myers, and Whitby. Timing Poor, Guide to Genetic Poor Returns While Investing in Successful Strategy. The paper is telling story about or showing story of value anomaly, and basically on hard data it shows that value anomaly preserves its return because most people time badly the value, because they enter the value funds in a time when the value spread is the lowest. And on the contrary, they increase the return of value factor at the end. So what is the conclusion of this paper at the end is that average investor in the value factor, in the value anomaly or value fund, at the end the average investor has a lower return than the market, and the reason for that is mostly due to bad timing, because he bought that fund or started to trade the value strategy in a bad time. So any anomalies or factors can be persistent, can have a nice performance in the future, simply they are simply badly traded, or they there is bad timing. Okay, and now here I come to p-hacking, or sometimes called data dredging, data fishing. As I have mentioned previously, 2 slides before, it's a use of data mining. So a lot of some, not a lot, some of researchers are just the people. So they are trying to mine data and try to look for patterns in data to try to show something which is as statistically significant, but without telling or specific hypothesis before, or simply they are trying to find something statistically significant and they do not tell or write in a research paper how many variations they tried in that research paper, or how many variations of the strategy they tried before they have found that strategy they are writing about. And this can be a really problem, because then there are problems with the replication of the trading research. And there is also nice research paper written by Xoue Zhang, they try to replicate data library with more than 400 anomalies on equities. And what they have found is that a lot of academics helped themselves, that they basically used microcaps and they do not use trading spreads and trading costs properly. So they have found the anomalies, but you were not able to use the anomalies in real trading, and more than 60% were insignificant once you removed microcaps and once you value weighted returns. So you have not used equal weighting in your research, which artificially, so when you use equal weighting and you are using microcaps, you give a higher weight to microcaps which are basically not tradable. Artificially you have a higher performance in the past, but you are not able to replicate it in the future. So these are the common problems in academic research. There is a nice idea how to cope with the replication problems and with the problem that there is increasing number of strategies which are published every year. Again, there is a nice research paper from 2014 by Harvey, Liu, and Zhu. They suggest continuously increasing t-statistic hurdle based on the number of published factors. So academic research started to look for strategies for anomalies in data in 1960s, and right now we have so many factors that it makes sense to increase the cutoff point for statistical significance at least to 3.0 or 3.5. So basically to be as hard as you can on the data on a strategy you have found, and to judge it really hard to say if it is really strategy which will work in the future, or if it's just some statistical fluke or a result of data mining. What can be also a good and interesting idea, and I personally like this, and I personally use it, is to let the hard data pick out the winners and let the hard data speak. Huang and Huang in 2014 performed a really nice analysis. They built a portfolio of equity factors based on published data. So basically, they built a portfolio strategy, and into that portfolio, they put anomaly or a system or trading strategy based on equities after it has been published in a journal. So basically, it's out of sample test. And we can compare it, I just put one chart from the paper into this presentation. We can compare this strategy, this out of sample strategy, It's the second from the bottom. It's average of published strategies. Compared to the naive basic benchmark S&P 500, I believe in this picture. But this is not the best performing strategy. The best performing strategy is not the naive average, but the portfolio strategy which performed momentum on published anomalies. So basically each year you will rank anomalies by performance in a trading period, 1 to 10 years, for example, and you will trade only the best performers in a subsequent year. You must have a huge database of trading strategies, of course, to be able to pick some significant part of it. But what you will get is you will get rid of strategies which are unreal, or which are p-hacked, or which are nearly arbitraged away, as they lacked performance in the lacked performance in the past. So you will basically not have them in that momentum portfolio of your strategies. It's not a bulletproof idea, of course. It's not a bulletproof, but statistically it can help, and it's a very interesting paper, and I personally like it. So final paper at the end, and I will give a short conclusion. So I hope you liked the presentation. I try to show you that you are able to find interesting ideas. You are able to find profitable strategies in academic research. So the answer to question, can we find profitable strategies in academic research, is yes, or I believe yes, we can find interesting ideas, but we need to look for blind. It's a good idea to look for blind spots. So look for assets, timeframes, instruments that are less covered by your research. We must understand that the performance of anomalies will decrease out of sample in our trading and post-publication. So once somebody will come with the same idea, so we can expect at least 40 to 60% performance decay. We must be aware of liquidity and transaction costs. So be aware if if the researcher is reviewing or speaking or writing about strategy which uses a lot of microcaps or trading on microcaps. It's better to use value-weighted portfolios and to remove the microcaps from a sample. It's good to increase the t-statistic hurdle for multiple tests. So have a higher hurdle than 2.0, which is common among academic papers. And my favorite and personally favorite, so let the data pick out the winners. So build a database of more strategies and pick some of them which have the better performance, are performing better. Okay, I would like to close my part of the presentation at this moment. I believe I will give my word to my friends from QuantInsti, and we will get to questions later. So at the moment, I would like to thank you for your attention.
Hi, Radovan. Arjun here. Thank you so much for taking that presentation for us. I'm going to be taking the presenter rights for you just for a quick minute. I just need to talk to the attendees for some things. I just wanted to introduce my attendees to the EPAT program, which is QuantInsti's program in algorithmic trading. You can visit our website, that's quantinsti.com/EPAT for further details, or contact us on the numbers that are mentioned on the screen right now. Talking about how EPAT can help you, just a couple of quick success stories. Looking at Marco Nicolas Debo, who has started his own trading firm in Argentina. You can read about his success story on our website. And one of the biggest questions faced by people entering the field of quantitative trading, whether they can manage to be a quant trader at a late age. So Mr. V. Shankar Narayan from India is working as a quant analyst after being a database expert for 20+ years. So yes, definitely quantitative trading is a field for everyone. If you feel you would like to start off with some small courses, we can look at Quantra, which are some self-paced learning courses offered by QuantInsti. You can check them by visiting quantra.quantinsti.com. And just to let you know that our prices would be increasing from the next batch of EPAT. Our batch is going to start on July 29th. Prices remain the same for this batch. For the batch starting in October, the prices are going to increase by approximately 11%. So I'm going to hand over the stage to Radovan once again so he can quickly take your questions. And in answer to the questions, yes, the presentation is being recorded and will be shared with everyone via email, the link to the uploaded version. Radovan, are you ready to take the questions?
Yes, I'm here. So if you have any question, you can ask it now. So I have one question from Raghav. What are some of the journals where one can look for such strategies that you talk about? We personally like free sources. There are a lot of journals. They are usually paid, like Journal of Portfolio Management and so on. But I personally recommend to go to website Social Science Network. It's www.ssrn.com. It's the repository of research papers from social science. So there are also other other not only financial papers, but you can use search engine and search by keywords. Like you can try to check or find papers about pairs trading. You can search and try to find strategy about momentum trading and so on. So there is a possibility to find something like that. And also you can check our own website quantpedia.com, where there are a lot of okay, one question: how you can access your database? So basically we are accessible on our webpage quantpedia.com. We have a paid and also free section. In a free section there are more than 60 most common and most known strategies. So there is a lot of knowledge accessible for free. And if you are interested, you can buy a premium section when there are more unique strategies. So these are the subscription plans. Then there is a question, which strategy should beginners look at? So yeah, the academic papers are very theoretical and very in-depth. That's true. I believe I would start with asset class picking, momentum strategies on ETFs. These are probably the easiest to grab, to understand. These are well-known papers and well-known strategies, and there are a lot of papers. And so I will start with the asset class picking, some sector rotational strategies on ETFs. So this is okay. Can you point out some methodologies for calculating beta decay of strategies? Good question. I would like to point you to read the academic papers I mentioned in my publication. I will not move back. There is not a link, but once the presentation will be online, you can simply Google the name and the name of the presentation and the name of the researchers, and you will get that the research paper and the papers which are dealing with that alpha decay. They have some interesting methodology. So you can this is the way I would point you. Okay, so additional question, could you point us to where we can get access to published papers in this quant area? As I have mentioned, our web page, or you can Google, you can try to Google it. I personally very like to use Google. You will just write academic paper, momentum strategy, and you will get a lot of links. You can write academic papers, sector rotation, and you will get and you can read and read and read. I personally read, I have not counted it, but it was like, as I said, tens of thousands of papers, but I have done it during the a lot of years. But there are a lot of papers available freely on the internet by just using Google. Okay, what programming language do you recommend? So there are a lot of questions from this point of view. Basically, everybody tries to program in what he likes. I tried Python, I tried Visual Basic, and R. We have a link, or we have a lot of links on our webpage. So I will point you to quantpedia.com/links, and there we have links for around 50 backtesters. And by backtesters, I mean there are a lot of tools which already have all of the data you need for different type of strategies. And there are for institutional clients, also for retail clients. And personally, I prefer Python language, but it's only my preference. And there are a lot of people who are using any other language, and I do not think that there is so much differences in what language you will pick. It's just simply pick one you are comfortable with and start with that one, or pick some pre-constructed solution from some provider like TradeStation, NinjaTrader, AmiBroker, and start to test in that one. So you will start as the time will go, you will get some proficiency, and you will get better in it. So there is not one good language. So this is the probably common question, and I will end it with this one.
Great. So thank you so much for that, Radovan, and thank you for taking the questions today. And it was a fantastic webinar that today you've taken, and I believe everyone would agree that it has been quite informational. All of my attendees, I would like to answer the biggest question that you have, that yes, this webinar will be recorded, and the link for the recording will be shared via email once it's been uploaded. And we would try to answer all of the questions that we've received by you by getting in touch with you personally over email or a phone call. I would also like to point you once again to EPAT and quantensity.com. You can visit our website, check out our flagship program, wherein we have trained a lot of professionals from a lot of countries and made them successful algorithmic traders. You can check out their success stories on the website. While there, if you are interested in short-term learning courses, you can also look at Quantra, which is self-paced learning courses. There are courses like statistical arbitrage trading, trading with machine learning using regression, trading using option sentiment indicators. So these are tools that would help you in becoming better algorithmic traders. So thank you once again for your time, Radovan. Thank you everyone for attending today's webinar.
Well, algorithmic trading requires you to merge two traditionally disjoint set of skills. One is finance, another is technology. So you need to merge skills in finance and technology to be able to do algorithmic trading. So you need to understand the markets, you need to understand big data statistics to be able to design your strategies. But once you have designed the strategies, you need to also understand technology to be able to automate your strategies. So therefore, that is where the Quantincity's education programs come into place. So we train people about the entire gamut of operations and skills required to be able to be a successful algorithmic trader.